Hello, everyone. Thank you for joining us today. We're honored to be sitting down with Josh Lawler. Josh is a partner at Zuber Lawler Law Firm out of Los Angeles. He's been there since 2005, where he's focused on finance, mergers and acquisitions, securities law, and technology transactions. He's also an equity partner and the leader of the new technology group at Zuber Lawler. Thank you so much, Josh, for joining us today.
Oh, it's my pleasure. Glad to be here.
So I've spoken with you in the past about particularly ETH 2.0 and the securities implications. And I was wondering if you could just give a brief primer for those who haven't thought of the securities implications of ETH 2.0.
Sure. So, it's a little bit like saying, "Can you read me the Bible in 3 days?" But I can do it somewhat. The way that the securities law currently views Ether and Ethereum, so Ether is the native token, is that it's likely a commodity. And I say likely because it was determined to be a commodity. And then at one point, somebody at the SEC kind of backwalked that a little bit and said, well, maybe not. But in the meantime, the CFTC is certainly treating it as a commodity. And part of that is that, currently, Ethereum is operating on a proof of work consensus algorithm the same way that Bitcoin does. And it's, highly distributed. So there's no true issuer. And, that seems to put it squarely in the realm of commodity rather than security. When ETH 2.0, when the update takes place, it's a little bit different because at that point, we'll be switching from a proof of work to a proof of stake consensus algorithm. And, from that perspective, the kind of reward system, if you will, for the ETH2 consensus algorithm changes a little bit in the sense that the folks who are mining have to actually be holding ETH to do it. And, that's their stake. And some would suggest that would mean they need to purchase ETH to begin with in order to do that. And does that make for some kind of an investment contract? Personally, I don't think it does. I think, right now, ETH is so widely distributed that, there is no kind of initial promoter issuing the ETH. So under the Securities Act, it's going to not satisfy the Howey test. And I guess for listeners who aren't familiar with the Howey's test in securities, I suppose I should back up. The way cryptocurrency in general might be a security is to be considered a, quote, investment contract. And investment contract is kind of the SEC's catch-all, if you will, for everything that is not specifically named as a stock or a bond or, any of those other types of things that are known financial products. So an investment contract is determined based upon 4 factors that come out of a case called SEC v. Howey, which is out of, I think, 1946. So it goes back a ways. And it's about orange trees and orange groves and management of orange groves. And what it basically says is that if you have a contract where, somebody makes an investment with an expectation that they're going to get a return on their investment based upon the efforts of others, so promoters of a corporation, for instance, operating in a common enterprise, that's going to be an investment contract. That was a very loose description, but nonetheless, that's going to be an investment contract. And therefore, for purposes of the Securities Act, it'll be a security. And I say for purposes of the Securities Act because the Securities Act deals with initial issuance of securities. And that's not necessarily the same thing as the Exchange Act, which is what all the cryptocurrency exchanges need to worry about. But I'll stop the digression there. So that's the Howey test. With ETH at this point, even though the consensus algorithm is changing, the token itself, the native token of Ether, that's not changing. And there's still, no promoter out there who is, specifically issuing ETH based on somebody making an investment. The way, in many cryptocurrencies, you've seen investments in, tokens, or for that matter, forward contracts called SAFTs to purchase tokens. This is completely different. So I don't really think ETH 2.0 is going to have any kind of an issue on a securities law front. It will still be a commodity and as such, to some degree regulated by the CFTC.
So not major changes as it relates to ETH and securities law overall, particularly for those who might be looking to build on top of it.
No. So, in terms of the Ether, it's not. In terms of a DApp token, distributed application token that operates on the Ethereum blockchain, that's going to have its own separate analysis under Howey for that token, whatever it may be. And, there's tons of them, obviously. So, that's going to be viewed in its own universe. So just because something is issued as an ERC20 or an ERC 721 or an ERC 1153, it doesn't really matter. It's not a question of whether Ether or the Ethereum blockchain is securities oriented. It's a question of whether that particular token or set of tokens is, going to pass the Howey test.
You've said you're drowning in NFTs these days. What are you seeing? What are you seeing from that space?
Oh my gosh. So non-fungible tokens, NFTs, for anybody who's not been beaten over the head with it the way I have, this is really a massive paradigm shift in, again, so many different things. Just really quick from a baseline perspective, what an NFT is it's a digital asset that is uniquely identified. So it's non-fungible. There are some that are semi-fungible, and there's certainly, you can have 2,000 separate NFTs that all entitle the holder to the same thing, but they're just all uniquely identified. So those 2,000 might be fungible within themselves. So it's a little bit of a misnomer. But when you get right down to it, what it is it's a basically pointer, if you will, on a blockchain that verifies that whoever holds that pointer, that non-fungible token, has certain rights and then points to those rights. So, in kind of the most current kind of aspect of it, you can see a lot of digital art being auctioned. For instance, on NFT Gateway or OpenSea or, Atomic or any of those. And notably, Beeple just sold his NFT for $69 million. And that NFT was actually able to be broken down to a bunch of other little smaller NFTs that all represented particular digital art. So, if somebody buys that, what you've really purchased is a publicly viewable spot on a blockchain that shows that you own that non-fungible token, or at least you control the wallet that has its private key. And therefore, the thing that it points to, which might be Beeple's art, or it could very well be something in the real world also, it could be a Picasso painting, that you have ownership of that item or somehow rights to ownership in that item. Now, what happened, the other piece of this is that it then becomes much more easily transferable. So, if I've got an NFT that entitles me to, ownership of a Picasso painting, because somewhere there's a Picasso painting in a vault and says whoever has this NFT has the rights to that, it's a lot easier for me to transfer that to you. If you want to purchase my Picasso painting, you can buy the NFT, and the painting itself never had to move. The other thing that's really interesting is that by smart contract, you can kind of burn into the logic of an NFT that, for instance, if it's sold, there's going to be a royalty paid to, in this case, Pablo Picasso, because he originally painted it. Now, that's very different than the current state of sale of content. There's something in the copyright law called the first sale doctrine, which basically means that if you're an author or a content creator, ordinarily you make money off of the first sale. If I write a book and I sell it to you, you buy the book, I get paid for the book, and that's great. If you then resell the book, I don't get anything out of that for that resale. You can bring it to, sell it to a family member, you can sell it online through eBay, it doesn't matter. There's no continuing royalty. With NFTs, you can set up, business logic within the non-fungible token that if you have it sell a second time, a third time, a fourth time, that a portion of the purchase price is going to get kicked off as a payment of a digital asset to whoever you set it up to be. So it might be me as the content creator, or if I'm a publisher, maybe it's the publisher and, I'm paying the content creator separately. But the point though is that the first sale doctrine, which has been present for more than 100 years, there's now a technological workaround to it. And I think you're going to see that this is the future of content distribution, and that a whole bunch of different business models, more than you can really imagine at this point, are going to come out of this. And just to kind of name a few, I already mentioned that you can have an ongoing royalty on secondary sales. You can also have things where, your NFT is a combination of things. It entitles you to, a piece of artwork, and it also entitles you to, some share of the income that's generated from other sales of that artwork. So you can basically have, kind of a multi-level sales scheme. And I say scheme on purpose, and I'll get back to the word scheme. You can have NFTs that represent rights to own stuff for a particular amount of time. So maybe you're buying it for, 10 days. Maybe I buy an NFT that entitles me to a virtual LeBron James dunking on a basketball hoop for one day, and I buy that for my birthday party. When we get into the world of augmented reality and virtual reality, which is going to be growing more and more, it's a natural way to verify ownership and to transfer ownership of digital assets that aren't actually stored anywhere other than the cloud. So, if that LeBron James dunking, and I mentioned that because that was a recent NFT sold, was, LeBron James dunking NFT. If I've got that and it's 3D and it's virtual reality and it looks like, I can put myself sitting under the hoop from any direction, that's something that I might get, so I can look at it in virtual reality, and that has a value to it, which, currently it's very difficult to figure out how to purchase and sell, virtual assets that way. And it's not really a market yet. But that's where the world's going. It's exciting stuff.
What are the regulators thinking right now when they're looking at NFTs?
So probably initially a great deal of confusion. On the securities front, I think the Securities and Exchange Commission is probably looking very carefully at the space, because there's a real chance that there's going to be a lot of accidental violations, very much the way that a lot of ICOs were accidental violations. There'll likely be some fraudulent ones also. That's a different category. But what principally concerns me, and what I advise my clients in the space, is just because it's called a non-fungible token doesn't mean that you're not selling it as a security. So, to give you an example of that, if I take the example of that Beeple piece of digital art, if I sell that based on the idea that this is Beeple, it's a piece of art, and yeah, we all know that art might go up in value, but I'm not selling this to you as an investment. I'm selling this to you because you've got an important artist and it's a collector's item, and you're buying it because you're a collector. That's fine. That's selling a piece of art. If I take that same non-fungible token that represents that piece of art and I say, okay, well, all of the other Beeple art has gone up by 200% within 2 weeks of purchase, and get this now before it disappears, because it's going to go up in value rapidly and you're going to be able to turn it around. Well, now that starts to look a lot like an investment under the Howey test. And if you run the kind of factors on it, there's an investment. The person buying it has an expectation that they're going to be a return on investment from it. They're investing in the efforts of others, which is to say that, Beeple's created this, and part of this, pitch is very well likely to be that there'll be continued creation and there'll be media coverage and, all kinds of other support. It really is a situation where, Beeple, or whatever not to pick on him, but, and I forget his real name, or whatever platform, has a lot more information in terms of how things are likely to happen. And certainly kind of having asymmetric information is one of the things the SEC looks at to see if you're investing in something where it's the efforts of others. So it starts to look a lot more like an investment. Now, if you take an example where you're talking about collectibles, and let's say, I'm an NFT creator and I issue, 10,000 NFTs that they're all non-fungible tokens, but they're all otherwise look, more or less the same. And, it's a picture of my dog or whatever. For some reason, that's something that's attractive to people. If I now say, okay, I'm going to sell 10,000 copies of this digital art of my dog, and each one is a individually authorized NFT, and these things are going to go up in value because look what's happening in the NFT space. And it could be my dog, it could be my fish, it doesn't really matter. It could be a picture of my foot. It's NFTs. I am definitely at that point engaging in the sale of securities, and that's a securities violation unless it's done in a particular way. And because most people rushing into the NFT space are not thinking of this at all, any more than the software engineers in 2016 and 17 were thinking about securities laws when they were doing ICOs. It's a disaster waiting to happen. And I do think it's going to happen. I do think the SEC is already aware of this, and is watching, the few current venues where people are purchasing NFTs, which thankfully are all fairly well run. But there are going to be some that spring up that aren't as well run. And there are going to be people who kind of fall into this. And, when that NFT of my dog that you bought for $3,000 turns out to be, worth, 30 cents at most, 4 weeks later, there's a problem with that. So that's one set of regulations. It's the biggest one, I think, that we're looking at.
I've heard people imply that because NFTs are collectibles, that they might be insulated from certain regulatory or by certain policies.
Mm-hmm. Sure. So, yeah. The thing about digital assets in general that is probably the hardest thing to get your head around is that one can be more than one thing at a time. So, in the cryptocurrency world, most of the tokens out there that, are expected to appreciate in value because there's a finite supply of them and they're required for some kind of a use case. And there's a growing demand for the use case. And the results, you've got a situation where, there's a finite number of them. As more people need them, the number of them that you use for the use case may decrease, but the value of the token itself increases just by supply and demand. So at that point, that token is, it's a consumer product in the sense that you might need it for the use case. It's potentially a security, depending on how it was offered. For the IRS, it's property. And, in the case of an NFT, sure, it's a collectible, but at the same time, it can be a financial product. At the same time, for the IRS, it is almost certainly going to be considered property and taxable. There are certainly cases where I could see the CFTC considering them to be a commodity, because, by the way, virtually everything, including collectibles, is a commodity. It just may not be regulated. So, if I sell my NFT and it's got a picture of a gold nugget, and that's a piece of art, but it actually entitles you to an actual gold nugget in a vault, then it's a collectible that's also representing title to a gold nugget. So there's not any insulation in the sense of because you're one thing, you can't be anything else. That's, I guess, the takeaway. The short form of that is, just because it's one thing doesn't mean it's not something else completely different for some other purpose.
What does it take for an NFT to look more like something that is malevolent, such as a trading card?
That is malevolent?
Benevolent, excuse me.
Oh, benevolent. Okay. I'm like evil trading cards. So, the thing again is it's manner of sale, I think, that's really going to drive all this. And, you can pick out NBA Top Shots is a great example of it. There is an NFT drop for the Garbage Pail Kids. Clients of ours are doing Bitcoin Origins, and these are all equivalent of trading cards. They're collectibles, and it's how it's sold. Right now, we all kind of know that there's a froth to the NFT market. It's new, and people are piling in, and kind of defies kind of reason. It's tulip bulb mania that people will buy just about anything. And because of that, you don't really have safety in being anything in particular, but the way the law works is, if I've got a trading card, I've got a Pokemon NFT, and I sell it based on the fact that it's a Pokemon NFT, and I market it as a Pokemon NFT. I say, come and get your Pokemon NFTs, and this may be useful even in a Pokemon game, who knows? But that's all I say. I make no reference whatsoever to resale value. I make no reference to the fact that the NFT world is, going through this amazing period where everything is just rocketing up in value. Then, it's hard to say that there's anything wrong with what I'm doing in selling that Pokemon NFT. If, on the other hand, I say, and this is actually for anybody who's followed the Kick case and stuff in cryptocurrency world, where they were basically selling tokens that entitled you to purchase an emoji of a honey badger. If I just say, okay, I've got an NFT, there happens to be a Pokemon on it, but who cares? It's going up in value. You're all going to be really wealthy because you buy this NFT at this point in time, and of course it's going to go up in value because right now is the very beginning, and all these Pokemon NFTs are going to be worth a fortune. At that point, I'm more likely selling a security. And there's also kind of guardrails you can put on it. So using the Pokemon NFT example, if I sell these and I sell 10,000 of them to a single purchaser, they're all NFTs, mind you, because they're all individually identifiable, but they're all the same Pokemon. And I sell 10,000 of those. There's no person that needs 10,000 collectible Pokemon NFTs that are the same Pokemon. They just don't. So at that point, it's very hard to kind of state that you're selling that for collectible value. On the other hand, if I have a rule that says you can buy up to 3 of these, they're $40 each, which is kind of expensive for a digital piece of art Pokemon, but they're $40 each, and you can spend up to $120. That's it. Or even I'll sell you a complete set of 200, but it's $1,500 and you can only buy one. At that point, there's a much stronger argument for the idea that you are selling it as a collectible, and the person buying it may or may not care about collecting Pokemon. They may be thinking, okay, well, this is the first collectible Pokemon NFT and it's going to become, ridiculously valuable. But in selling it, you didn't say that to them. And, their belief in that increase in value may or may not be reasonable. But you can say, if the SEC ever comes knocking, guys, I was selling Pokemon NFTs, they're collectibles. And you can look at every piece of anything that I've said, whether it's recording on the internet or conferences or anywhere else, and you're never going to catch me saying anything about the fact that this Pokemon NFT is going to go up in value. That's a pretty good position. But again, it's not about the fact that it was a Pokemon NFT. It was about the fact of how I sold that Pokemon NFT, if that makes sense.
The NFT craze snuck up on me. DeFi was quite popular. That's intriguing to me because there are some sophisticated products and services that are being theorized about in a decentralized context. And then here comes NFT, which is very popular mainstream culture. Go to MLB.com. There's Taiwan Walker today. He's issuing an NFT, a rap group I like from Los Angeles. There, People Under the Stairs. I saw that one of the members verified his Twitter account via Rarible.com, which is an NFT platform.
Mm-hmm.
What's it been like from your perspective with NFTs kind of just appearing out of nowhere? Did they kind of sneak up on you like they did me? Did you see them? And did you see their potential?
Yeah, so they didn't sneak up on me, but the craze certainly did. So, I've been talking with folks in the NFT space for, it's probably close to a year at this point, to try to figure out, what we were going to do with the space and what was going to happen. And in the last month or so, it's hit mainstream. And of course, it's driven a lot by the fact that a lot of these NFTs are being auctioned for, ridiculous amounts of money. And I don't think that that's going to continue for a super long time, in part because everybody's rushing in and suddenly there's just a lot more NFTs available for people to buy. But it has certainly caught a lot of people by surprise. I've had a lot of discussions in the last 2 weeks with sports teams and sports leagues, with lawyers that represent, musicians and owners of other content. I've had discussions with, people who represent, athletes. There's a very big play on this in the amateur athlete world. There's right now a court battle going on still with, whether the NCAA is allowed to say that, and, athletes can't be paid. But, quite honestly, even if the NCAA wins that and says athletes can't get paid, I don't think it's going to be able to say athletes can't create their own NFTs. So if you're, the number 10 rated high school basketball player in the country, you probably have enough popularity that you can go, and it's not that hard to create an NFT and to issue it. It's sometimes you could say it's difficult to do right. It's difficult to maximize, but it's easy to do. So from that perspective, yeah, it's a massive explosion of popularity, and all kinds of people have all kinds of questions on it. And, there's still some of those questions that we don't know the answers to yet, because, it's very new. And just to, digress a little bit, because you mentioned DeFi, and, DeFi, or decentralized finance, is also, just a massive kind of paradigm shift in terms of, models for handling, money and trade, that are, going to have a huge effect on, all kinds of things. So, if you take DeFi and you take NFTs and you take, the cryptocurrency kind of base use case item of just decentralization, it's huge, and there are going to be other things. And what I find is a really good metaphor for people to understand what's going on is that if you think about the dawn of human existence, and there's a guy in a cave, and he's the guy who gets to count up the mammoth steaks and the berries, that guy's a centralized ledger. He's the guy who's counting. And everything from that point to, 2010-ish, I guess, has been centralized ledger oriented. And when I say everything, I mean everything. It's accounting, it's society, it's politics, it's religion, it's government. It's like literally, there is no way that we've been able to get around the idea that there's one copy of the books, unless, of course, you set a situation where there's two copies of the books, but that was probably it at that point. And beyond that, you need brokers and escrows and other third parties who are trusted authorities to go in and audit things to make sure that they match. And what's shifted now is the idea that there is, instead of one guy or two guys with the books, there's thousands. And there's a consensus algorithm in place that's designed through, normal incentives to allow people to validate that the books are accurate and that a transaction that is put in place is a valid transaction. And that shift is amazingly important and large. I mean, it's hard to imagine a bigger shift, honestly. And I'm a technology guy and a futurist. I thought nanotech was kind of the be all end all, because that changed material science in a way that's difficult to really comprehend. But this goes well beyond it, because it changes pretty much the entire way that, you've got people behaving. It's just the entire game changes. So, NFTs are just the latest iteration of that. And in this case, it's about ownership, really. And certainly ownership of intellectual property and content is kind of the first piece of this. But, I don't think we're too far away from the idea that instead of a VIN number on a car, there's an NFT. And that's how you've got ownership of the car. So that's where we're going.
Mike Hearn gave a speech in London in 2012 where he gave this use case of how a smart contract might be deployed on the Bitcoin blockchain at this time. That, of course, was before the block size debate, which sent Bitcoin down a particular path. But at that point, he was still imagining a world in which on top of the Bitcoin blockchain, there was something like smart contracts. And he used this example of like an NFT or a non-fungible tokenized car as an example of how that might be used.
Yeah, absolutely. And there's all kinds of use cases. I mean, one of the ones that I love is, there's all kinds of self-sovereign identity aspects to this. So, an NFT that ties into a locker where you've got all of your medical history is kind of a natural one. An NFT that ties into a locker that's got your full genome stored in it is another. And, that's something that I know a particular company that's been pursuing that for quite some time. And there's all kinds of models that go off of that stuff being available. So yeah, and obviously it just becomes a lot easier to move things around also. I don't know if you've wrestled with having your medical records go from one doctor to another lately, but they're still using fax machines, which is insane.
I spoke with somebody who is trying to build a decentralized kind of regulatory layer. Mm-hmm. And his argument is that regulation, as it's written today and implemented, doesn't fit with the way in which DeFi is working. Is that true? How and how not? And then are we heading towards an entire new paradigm of regulation?
Oh, so, all right, to start with the easy part, it doesn't fit. Regulation doesn't fit. The idea of a new paradigm of regulation is almost one of those oxymorons that you've got the running jokes being military intelligence and Thanksgiving at our house. Unfortunately, law doesn't move fast, and when it comes to technology, the law is always behind, and it's getting further and further behind. And what happens, and it's nobody's fault. It's the way things should work, honestly, is that you have a technology create a societal issue. And just to use the ICO craze, because it's a very easy one to pick on, the societal issue was that there are a lot of people investing their life savings into stuff that they knew nothing about, without any kind of disclosure and no protections. So, were those original tokens really securities? It's arguable. It's up for debate. But what I can tell you is that the SEC has a mandate of maintaining orderly markets and protecting the Main Street investors. And because somebody labeled an ICO as an ICO as opposed to an IPO, and because the Main Street investor is getting absolutely hammered with zero protection whatsoever and dreams of getting rich quick and hodling and Lambos and to the moon, they had to jump in. They really had no choice, because somebody had to jump in. I would have preferred if it had been the FTC, but somebody had to jump in, because that was just not something that society could allow to happen. Now, unfortunately, what happens then is, the SEC jumps in, and what do they have to do? They have to establish they've got jurisdiction and that somebody's violating a law. So how do you do that? Well, you look at the existing law and you figure out how to crowbar this new thing into it. And that is why we've got a case from 1946 determining whether or not a digital asset is a security or not. And it doesn't work. It breaks down in all kinds of places, but it's kind of the best thing that we have. So, you take that and you think, okay, well, what does it take to change that situation? And the answer is that it takes somebody to rewrite the law. It takes legislation. And at that point, you're asking for a bunch of politicians who know nothing about the space to balance a whole bunch of different, interests, which, vary from innovation and keeping up with the rest of the world, through protecting the Main Street investor, through legacy interests that are lobbying them and paying for their political campaigns. And, the short version is that it doesn't happen fast. It doesn't happen easily. And a lot of the time it doesn't happen right. From that perspective, I think it's going to take a long time. And, to some degree, you get some relief in the courts, who are able to interpret law and kind of say, well, if this had existed at the time this law was written, is that what they would have intended? And, it's kind of a little bit of a mess. And, as they say, it's a horrible system, but it's the best one we've got. So there you go.
What led you down the path of the legal world? Is it something that you were interested in younger? When I look at law in general, I see history in a lot of ways and a long evolution to get to where we are now with how laws are written. What attracted you to this profession?
I'd like to say something high-minded, like I've always intended to do that, or I've always been fascinated, but that's not really the truth for me. I graduated college. I was looking around for what I would do, and law school was something that I thought, okay, it's more school. I enjoyed school, and it kind of fit with the idea of I'm not mature enough to join the workforce yet, so I went to law school. And once you're in law school, you're kind of on a track in the sense of, it's very easy to go through law school, and if you do well, to go and get a job at a law firm, and at that point, you're paid pretty well, and the rest, as they say, is history. So that kind of got me going in that direction. But I've been very fortunate in that I've always been very much a futurist and technology minded, and I have a hard science background. And as things happen, I pay some level of attention. When Bitcoin initially was coming out and blockchain, I will confess that I really did not understand it, and I was a little too busy playing lawyer. And I did not buy Bitcoin early, as many of my friends did, and they're in very different places now than I am. But in 2017, when it became securities law oriented, which is a space I've been in for over 20 years, that combined with the fact that it was a technology got me to start really looking into things. And I started trading myself, and because I was trading and like to know what I'm doing, I started reading a lot of white papers. And I really can only say that I got lucky, and I'm blessed, because it just all makes sense to me. And as I talk with more people in the industry, I got kind of further and further down the rabbit hole, to a point where I'm now really an evangelist for distributed ledger technology and the applications and the efficiencies and a bunch of other things of that nature. So from where I'm sitting, at this point in my career, I actually feel like I'm more directed and motivated and purposeful than I ever have been, because I see what this can do for the world. And it's really amazing stuff, as we've discussed. So I'm not as focused in what I was thinking of when I was 21 years old and decided to go to law school, as I am, over the last 4 or 5 years, as I've kind of watched how the technology is spread. And, it's some amazing stuff. I mean, the potential here for, helping people is just huge. Whole swaths of the population that, have been kind of off the grid are able to be kind of more addressed. Decentralized finance is a lot of things, but one of the things it does is it cuts out a lot of middlemen. It cuts out a lot of fees and things of that nature. And right now, it's really hard to understand it. So it's in a small universe, but at some point, the user interfaces and such are going to get better, and that's where we're going. And I don't think any would get any argument from that from anybody in the main Wall Street firms either. I mean, they all recognize it at this point and are acting accordingly. As I mentioned with NFTs, I mean, this is the future of ownership of things. It's all going to be identified this way. So I'm looking forward to seeing kind of how the world progresses, and trying to do my part to make sure that happens in a way that works for people.
I studied history in school, and so I've been looking at history from a historical perspective, and it's been interesting to watch the history of Bitcoin, for instance, and then blockchain evolve. There was sort of there's the Silk Road days before Ross Ulbricht was apprehended in the San Francisco library. And it was interesting to see how that rolled into a block size debate that was quite ferocious in many ways. And then that was kind of put on the back burner and out of the mainstream, as what I called the year of blockchain, which is 2015, kind of became the main story. So we morphed from this narrative of Bitcoin to blockchain, and Bitcoin as a use case on top of blockchain. And then Ethereum, that's a kind of a subhistory of all of this, I'd say. And now we have DeFi, and we've got NFTs, which are like, I don't want to say out of left field, but wow, NFTs and Dogecoin are what brought crypto to the masses. But I'm curious, has it been interesting from kind of a legal perspective to watch how this brand new industry has been responded to, and how it's responded to regulators and laws in general?
Yes, it really has. That's a great question. You know, the initial bit of this, you know, and I'll skip the Silk Road piece of it where it was just, you know, it's the dark money that the criminals use, because, you know, I think we all kind of have that. And then the Mt. Gox hack was kind of a little bit of a low point, I think, because then it was not even safe for normal people to some degree. But, you know, what took place in 2016, 17 with the ICOs was, you know, in my mind, primarily a lot of software engineers who are very smart figured out that they could raise money for their projects in a way that did not involve giving away equity, did not involve beating themselves up, going around, you know, Sand Hill Road in Silicon Valley, getting rejected over and over again, putting a pitch deck together constantly, and basically generally being distracted from their project a great deal. So they took it, and they really didn't think much more about it than that. And in some cases, you know, their hearts were in the right place, and they really were just trying to raise money responsibly for, you know, their project. And, you know, what do they know about securities law? You know, nothing. You know, it's just not where they're focused, no more than I know about software engineering, which is very, very little, trust me. And then once kind of that started happening, you've got kind of the profiteer fraudster group that steps in and says, wow, I can raise $60 million in 15 minutes by doing this. And, you know, that proliferated, and that really sent things off the rails to a point where, you know, it was kind of, you know, the banks are looking at crypto and they're like, wow, we can't take this. You know, it's fraudulent. There's bad activity. It facilitates, you know, terrorism, whatever else you want to say. And, you know, at that point, it's Q4 2017 and 2018, you know, we kind of go into crypto winter, and everybody's afraid of the SEC. And, you know, is there a way to do this? A lot of different models are being explored. You know, Jay Clayton actually issues a statement saying that he's disappointed in the legal community, who are supposed to be the gatekeepers to prevent this type of thing, which, you know, as you can imagine, sends a scare through my industry in terms of, you know, what you're going to allow happen and what you're not. And that thins the herd a great deal. You know, it became very difficult at that point to, you know, in the United States, at least, do a token offering. And, you know, that continued, and certainly the Telegram piece of it, where, you know, I personally think Telegram was a horribly, horribly decided decision that does all kinds of violence to existing securities law, as far as, you know, declaring these people statutory underwriters. Longer story. But the point is that, you know, it's become very difficult to do a token offering. Well, you know, that's had a very interesting effect, which is it sent people back to raising funds the way that they used to raise funds, which is to say, you go around to sophisticated investors. They may be VC funds, they may be, you know, high net worth individuals, and, you know, people are selling equity again, and they're doing convertible notes and things of that nature. And yeah, there might be a token component to it, but usually if there is, there's going to be some type of a lockup period or vesting or something else to make sure that when the tokens are being issued, you know, it's not in the sense of it being, you know, the full investment. The investment's really the equity. And that it's led to greater responsibility. And the projects that I see now, when my phone rings and somebody says, hey, I want to do something, you know, most of the time, they're pretty sophisticated people with pretty sophisticated projects that have actual use cases that require a distributed ledger of some sort, usually a blockchain, but not always. And that's fantastic. And I think, you know, DeFi, for the most part, came out of that. You know, there's not too many of the DeFi platforms that, you know, they did one thing that I look at and I kind of squint a little bit, and that's the Gov token that, you know, supposedly has no financial benefit, and yet people are paying a fortune for. We all recognize that at some point they can vote themselves their own kind of payment, and so that's a little bit weird. But beyond that, DeFi has been primarily pretty responsible. They recognize that they're being regulated. They recognize people are watching. They're trying to do things correctly, which is fantastic. The NFT space so far, I think that that's correct in terms of the existing venues and platforms. But I think you're going to get a lot of people who rush into the space because there's a lot of money being spent very fast too. are going to be back at that, software engineer that understands securities law or that profiteer fraudster level. And, that'll happen. And, at that point, I kind of hope that the regulators figure out a way to go after those folks without doing too much damage to the underlying innovation that we have.
People are saying that the ICOs of this bull run of today, which are going quite crazy right now, are more mature than those of 2017 and 2018. And you kind of intonated that here. Can you kind of elaborate on that? Are you seeing that same thing across the board in ICOs? Yeah, go ahead.
Yeah, no, I mean, absolutely. So for one thing, one of those tests on the, one of those factors on the Howey test boils down to how decentralized are you? And that in turn boils down to really, is your mainnet up and functioning? Who's operating the nodes? How far out are they? And, what's all that look like? And that's been known now for a while. 2019, the SEC, I think it was April 2019, the SEC issued their framework that had that as a factor. So the projects that you see now tend to come online functional, as opposed to operating off of a SAFT where they're, raising money to build the platform. That in this country is not as frequent. It still happens in other countries, certainly. And I'm not really against that with the right disclosure, but from where we are here, things are coming in, they're more mature. The people behind them tend to have more experience also and have kind of proven themselves and tend to be more trustworthy, for lack of a better word. The platforms that distributed applications rest on are further developed. We still are waiting for Ether to be, a proof of stake. We'll get there. But, at the same time, it functions. Tezos functions. That's, a good thing. Cardano is functioning. There's stuff on it. And even, some of the EOS.io stuff, so EOS and Telos, that, you can build stuff on them now that works. And, there's also things are easier to build at this point. There's been a development of just, software evolution that makes it easier to do things. So yeah, I mean, the answer to the question is I absolutely think we're in a better shape than we were back then.
What are some of the technologies that you're seeing right now that excite you most in terms of how this technology can be applied?
Okay. So, it'd be hard for me. I already mentioned it, but it would be hard for me to beat the fact that you can use NFTs to get you over the first sale doctrine and copyright, so that, a creator or owner can make money off of the second and third and fourth, et cetera, sale down the line. That's just a massive switch. And I think it really empowers creators, and empowering creators, I think, leads to a much kind of wider and richer cultural atmosphere when you don't have, the equivalent of a record company or a film studio telling you what it is that you want to see because they know what's going to make them money. So, being able to open that up is extremely exciting to me. The DeFi protocols that have, third party and, individuals or what have you, acting basically, providing the assets to form liquidity pools as an alternative liquidity method to market makers, is huge, because, you just knocked out the market maker taking the bid and the ask spread, which, just drains money out of the market that, investors normally are doing, because, that whole market making role just got, I don't want to say replaced, but it kind of did. At the same time, and in exactly the same way, the fact that you can go onto, a swap site and swap tokens from a liquidity pool, and you pay for that, but you're paying a commission that's going to the providers of the liquidity, who are regular people. Well, that's kind of an end around from a transaction fee that you might have on an exchange. So, if you're Coinbase, for instance, and, they're very good for a lot of things, but if their model is based on transaction fees taken off of an exchange, I would be very, very nervous about the fact that you're competing against a DEX, a decentralized exchange, where the transaction fee is going to be lower because it's not paid to the exchange, it's paid to the people providing the actual liquidity. That's a huge change. It's really massive. And then, in the securities world, and I focus very heavily on this, the idea of shifting away from, what is basically a paper-based paradigm of, having a security that's a piece of paper, even if it's now considered electronic, but it's still based as if it were a piece of paper, that, you have to have a central clearing agency. And then that clearing agency's got, members who have accounts at the clearing agency, and then those members in turn get to talk to the retail folks. So all of that infrastructure doesn't have to be there, at least not for the same reasons it was before, which is kind of the logistics of just facilitating trading. It may need to be there for other reasons. I've got nothing against the folks doing custody, because as it turns out, people are generally speaking better off if they've got somebody professional keeping track of their financial products. But you don't need that whole settlement and clearing layer, which is, it's a huge statement. So I'm very excited by a lot of this stuff.
For someone who's looking to issue an NFT, what do they need to know first?
Well, the number one thing, and I tell my clients this, sell it as a collectible, not as a security, unless you're ready to make securities disclosure and behave as if it was a security. That's number one with a bullet, no question, because people are going to get in trouble with that. It's just inevitable.
Any other comments?
Thank you for giving me the soapbox. It's been a lot of fun to kind of get my brain squeezed for all this stuff. We're at a very exciting time. When you kind of are 100 years from now and you're being a student of history and you look at what's happening, what's going on right now is going to be looked at very much the way that the invention of the printing press, or the widespread distribution of the printing press, might have been looked at, or movable type on that front. It's funny because it's really just a change of how something is perceived. But the paradigm, it's the first time I remember this ever actually happening, or I can think of, where all we did is somebody came up with the idea and figured out how to have an unlimited number of people have copies of the account books. And that shift, which it's not even like a new technology. It's new technology, but it's not like a new physical substance. It's not like we came someplace and invented the computer, or suddenly we have bronze instead of just iron. That's what it's going to look like. And who knows what's going to be next. I mean, this stuff all happens exponentially. The fact that we've got this explosion of new kind of paradigms across so many different aspects of life, who knows what that's going to breed. I mean, it's an incredible time to be alive.
We've been honored to sit down today with Josh Lawler. Josh is a partner at Zuber Lawler, where he's been since 2005, focusing on finance, mergers and acquisitions, securities law, and technology transactions, and of course, blockchain. You can find Josh on Twitter at JLawlerCal, as in California. So that's at JLAWLERCAL. Is there anywhere else people can find you, Josh?
You can always email me at my firm, and I'm fairly responsive. That's jlawler@zuberlawler.com. And you can certainly find me on LinkedIn as well. Those are the primary spots. And in the last year, you can find me in my living room, because that's pretty much where I am all the time.
You and me, and probably a lot of the listeners too.
Yeah.
Thank you everyone for listening to us today, and thank you, Josh, for joining us.
Oh, my pleasure. Thank you, Justin.